Hi Mortgage Heroes, Andy Cruz here in Business Development, and this is your weekly video newsletter. I know it's been several weeks since we came to you last, and actually the timeliness of today's video could not be more important. Ending the month of September, coming into the fourth quarter of the year 2021, it seems like it's flown by, but we have something very, very important to talk to you about today. Well, the bottom line up front, refinance now. Rate and term or cash out refinance. And here's your top 3 reasons. Reason number 1. Home equity is the highest it's been since the housing collapse of 2008 and 2009. Number 2, rates were artificially low all year due to the Fed injecting $120 billion a month into the markets. And number 3, the window of opportunity is closing, and it only started a couple of days ago, but we know when it'll end, May 2022. Keep watching to gain more in-depth insight as to why this is happening and what you can do about it. So how did we get here? To keep financial markets moving in 2020 and to avoid all-out collapse, the Fed stepped in and started purchasing $120 billion with a B in bonds per month. This directly shares risk with the open markets and also creates large baskets of new money available to be lent out. So what do we know from the law of supply and demand? When there's a lot of supply of something, it's cheaper to get. When there is less supply of something, it's more expensive. What we had here was a situation where the Fed's participation really altered 2 functions, risk and supply. Then what happened is the greatest purchase and refinance run the mortgage industry had ever seen in a short window of time happened, only rivaled by the early 2000s, which turned out to be a bunch of risky loan types and artificially inflated home values. Today, what we have is home values which rose as a direct correlation to the cheap cost to borrow, because that means you can now afford more home. Coupled with the behavior shift of large swaths of Americans rethinking what they want their home life to look like. What if I have to stay home to work? What if my kids are doing distance learning long term? What if the locations I like to frequent shut down temporarily or maybe even permanently? So on and so forth. We saw consumer behavior change big time in how people shop, move from place to place, where they spend their time, how they spend their time, and who they spend their time with. Well, what's that got to do with housing? The home took on a whole new level of importance in 2020 and 2021. We all chose or were forced to rethink how we do life. As a result, there was a surge of demand, especially people who were fleeing dense urban areas for more spacious, single-family, home-type neighborhoods, and even some who fled the state of California for less restrictive measures found in other states. Add to that a less expensive barrier to entry in order to acquire that dream home in another state, and you saw a crazy run-up of demand, which pushed prices even higher. For homeowners who hunkered down and decided to stay put, their decisions were much more financially influenced so that the home they kept could be less expensive or could do the heavy lifting and become the cash machine for the upgrades, expansions, and remodels people aspired to complete. Refinance volumes were through the roof in 2020 as banks and lending institutions posted their highest funding volumes in history. As the economic train rolled on, we started to see data emerge which began to change the tone of the Fed. Measurements such as inflation and unemployment became the 2 most commonly cited figures under their microscope as barometers which would determine when they would begin to ease up their $120 billion a month in participation. Recently, you've probably heard the term tapering, which is just their way of saying they will be less involved in the markets over the course of months ahead. Tapering was floated mid-2021 as something they were talking about, but that they did not have a specific time frame for beginning to taper and were focused on the fundamentals which would support that eventual move to start decreasing their participation in the markets. Jump to September 2021. After the Fed concluded their 2-day meeting on Wednesday, September 22nd, Fed Chairman Powell in his prepared remarks commented that they expect tapering to conclude by mid-2022, but made no mention of when that would begin. So let's put our rational thinking caps on for a second and think this through. In order to hand off all the risk back onto the open markets in only 9 months, September 2021 to mid-2022, let's just say end of June 22. What would be the least shock to the system? Spreading out that decrease in participation or doing chunks at the last minute? I hope you concluded spreading out the participation because that's what it seems like is happening. So what does all this have to do with mortgage rates? As we previously discussed, mortgage rates come from mortgage-backed securities, and volatility in the bond market can shift and change mortgage rates during any trading day. Here's an example. As you can see in this chart, there are daily candlesticks showing fluctuations in the 10-year note. From July to August, things were bouncing around in this 1.175 to 1.350 range. Then the Fed made their comments last week about when tapering would end, and the daily candle rocketed up because now the markets know when the Fed will be all the way out. Time will tell if that's the actual conclusion of their tapering, but you can see the reaction went right into a previous area of interest, marked off in the grayed out rectangle. In the 4 trading days since the move up, the 10-year note has continued to climb and has not yet returned to that marked off area of interest to create a support. How this directly affects you as a homeowner is it makes mortgage rates increase. Thursday, September 23rd, Friday, September 24th, Monday, September 27th, Tuesday, September 28th, has mounted increasing pressure on mortgage rates offered by banks today. And that is why today's video is so important. Applying the law of supply and demand would predict that an increase in rates would decrease the cost one would be able to afford, right? So it's likely we will see a flattening of home prices because now we have a new affordability struggle on our hands. If your rate increased by 0.25% or 0.5%, then what you can afford decreases. And this brings us to the apex of Q4 2021 refinances now, while your equity is at its highest and the rates are still relatively low. Projecting out the next few months, you should expect to see home values stabilize and begin to flatten. Simply put, if you need to cash out or refinance to eliminate mortgage insurance, do it while you can. You should also expect interest rates to rise throughout the period starting now and persisting to mid-2022 when the Fed expects to be completely out of the market. Unfortunately, I cannot support the argument that lower rates are on the horizon because technical data plus Fed speak does not add up to that outcome. The historical low lows of 2020 and early 2021 are in the rear view mirror as I'm recording this message. So your best option is to take action while you still have the relevant factors in your favor as a homeowner. So what are my options? There are a lot of choices in the market still, especially given the data we've discussed today. We're now going to overview all the sensible choices you can still make this year to secure your mortgage financial future. Here are your VA loan options. First, the VA IRRRL, up to 100% value. Short for the VA Interest Rate Reduction Refinance Loan. This is a VA version of a streamlined refinance. The process is easily accessible, quick to complete, with no out-of-pocket expenses. There's a mandatory savings requirement in order for the bank, and therefore the VA guarantee, to fund and close your loan. In short, unless you save enough money monthly, we can't even offer it to you. We personally believe this is a very strong safeguard that prevents VA-eligible homeowners getting scammed. Next, the VA Cash Out, up to 100%. This is the VA product that allows you to pull out home equity as cash for whatever reasons you'd like. Debt consolidation is one of them. Paying off high interest loans or credit cards, high balance loans, car loans, student debt, or any combination of these. Additionally, save money for a rainy day. Are you worried about the economic outlook? Stash some cash if you'd like. Schooling and tuition. Private school or college savings have emerged as two more recent explanations clients have told us they are using their cash out for. And also, make your forever home a forever home you want to live in forever by remodeling or upgrading and making those changes that your friends have done in the last year to year and a half. But now it's your turn to let your home pay for that too. Now let's take a quick look at our conventional rate and term options. Rate and term refinance up to 80% loan to value. This is pretty much a rate reduction only to reduce your monthly mortgage payment, and there is no mortgage insurance. Rate and term up to 80% loan to value to eliminate mortgage insurance on your existing loan. If you have a conventional loan or an FHA loan with mortgage insurance, you can refinance out of that loan now and eliminate the mortgage insurance moving forward. As long as you have 20% equity in your home, you could be looking at saving hundreds of dollars a month by eliminating your current mortgage insurance. Next, Rate and term with greater than 80% loan to value. This scenario would be for those of you who still have a high market rate from 2019 or prior, and even with mortgage insurance, because you have less than 20% equity, would still benefit from today's rate and monthly savings. My suspicion is most of you watching this have well over 20% equity as a result of the last 2 years run up in home prices, but talk with us and we'll help you sort all of it out so you can make the right choice. Next, we're going to review the conventional cash out options. First, let's talk about cash out up to 80% loan to value with no mortgage insurance. As previously mentioned in the VA cash out section, reasons you'd want to do this pertain to debt consolidation, saving for a rainy day, schooling and tuition, or upgrading your forever home. Next, you can convert your current VA loan into a conventional loan to free up your VA eligibility for an out-of-state move you plan to make. Whether it's in 6 months, 2 years, or beyond, getting out of your current VA loan and into a conventional loan allows you to reinstate your VA eligibility for subsequent use down the road. This means if you end up moving elsewhere in the country, you could tackle that purchase with 100% VA financing. We are seeing a lot of this from our active duty members who know they will be PCSing in 2023, 2024, 2025, and beyond. They plan to purchase a home in their next duty station using their VA benefit and want to keep their home in San Diego. After all, when they PCS out, don't we also have active duty PCSing into San Diego? Yes, we do, and they'll need a place to stay. In conclusion, the time is now for all of you who waited to refinance your home and set your mortgage future in motion. We know that rates on the table just a few short months ago are not here for us now. We can ascertain that an increase in rates is likely to continue barring a catastrophic black swan type of global economic or even just United States economic unraveling. The Fed has told us enough to come to these conclusions, and the window to maneuver yourself into proper position for the future is now. The equity is there. The window of the bottom of the rate market is slowly closing, and we can reasonably conclude that higher costs are on the horizon. If anything in this video spoke to you, sounded like things you've been asking yourself, covered options you've previously mulled around in your mind, please let us know so we can help you. We are ready to help our past clients, plus your family and friends who may not know what we've shared with you today. You can call, email, direct message, or comment on this video so we can get started helping you right away. Remember to share this video so you can be helping others understand what's at stake so they can also make their best choice for their family too. Thank you so much for watching, and we'll see you next time.